Today, we're talking about something most of us handle almost every day, the US dollar. But here's a thought. What if the dollar wasn't just money, but a product with a price tag that's always changing? Let's dig into what that price really means.
So we're going to jump right into the big question. Is a stronger dollar actually a good thing for the US economy? I mean, we always hear people talk about a strong dollar like it's a gold medal for the country. But is it really that simple?
To get why this matters, you have to appreciate the sheer scale we're talking about. Every single day, something like $6.6 trillion gets traded on the foreign exchange market. That is, by far, the largest market in the world. It makes stock markets look tiny. So yeah, the price of the dollar isn't some minor detail. It's a huge global force.
Okay, so if you remember one thing from this, make it this. An exchange rate is just a price. That's it. It's the price you pay to buy another country's currency. And just like the price of anything, a car, a coffee, you name it, when that price changes, you're always going to have winners and you're always going to have losers.
So, who exactly are these winners and losers when the dollar's price tag shifts? Well, before we can get into that, we need to make sure we're on the same page with a couple of key terms.
So when you hear that the dollar is appreciating or strengthening, it's simple. It just means its price went up. Your $1 can now buy you more euros, more yen, more of whatever than it could before. Your buying power abroad just got a boost.
And you guessed it, the opposite is depreciating or weakening. This just means the dollar's price fell. Now that same dollar buys you less foreign currency than it used to.
And here is the absolute core logic of how this all works. It's a two-way street. If the dollar gets stronger against the euro, then by definition, the euro has to have gotten weaker against the dollar. They are perfect mirror images. One cannot move without the other moving in the opposite direction.
And this creates a really clear divide. A stronger dollar is fantastic for US tourists heading abroad. Your vacation just got cheaper. It's also great for companies that import foreign goods. But it really hurts US exporters, because all of a sudden their products are way more expensive for everyone else. And it makes it a lot pricier for foreign tourists who want to come visit the US.
So this quote really just nails it. We have to ditch this idea that strong automatically equals good. I mean, ask a US factory owner who just lost a massive overseas contract because their prices got too high. For them, a strong dollar feels anything but good. It really is all about where you stand.
Okay, so if the exchange rate is really just a price, what are the forces that are actually pushing it up and down? Let's take a look behind the curtain.
And it all comes back to the most fundamental concept in economics, right? The price of a dollar is simply set where the global demand for dollars meets the global supply of dollars. So the real question is, what makes that supply and demand wiggle around?
Well, economists usually point to three main drivers. First up, expectations. If big-time investors think the dollar is going to get stronger, they'll buy more of it right now to get ahead of the curve, which, makes it stronger right now. It's a classic self-fulfilling prophecy. Second, rates of return. If you can get a higher interest rate on an investment in the US than in, say, Germany, you'll demand dollars to make that US investment. That pushes the dollar up. And third, inflation. If inflation is high, it's eating away at your money's value, making that currency less attractive and causing it to weaken.
Now, over the long haul, there's another idea that kind of acts like an anchor for all this short-term movement. It's called purchasing power parity, or PPP for short. The basic idea is that a product, let's say a new laptop, should cost about the same in the United States as it does in Japan once you do the currency conversion.
And I think this is the best way to imagine it. PPP is like a long-term gravitational pull. In the short term, yeah, exchange rates can fly all over the place because of speculation and interest rates and all that noise. But over many years, they tend to drift back towards that PPP level.
Now, some governments really don't like the idea of leaving such a critical price up to the whims of the market. And this brings us to a huge policy choice that every single country has to make. Do we try to control the price of our money or not?
So first, you've got the hands-off approach, a floating exchange rate. This is what the US does. The government and the central bank basically say, hey, market, you figure it out. They let supply and demand determine the dollar's value day in and day out. It's really flexible, but boy, can it be volatile.
The alternative is a pegged exchange rate. This is the total hands-on approach. Here, a country's central bank is actively in the market, buying or selling its own currency to keep its price locked at a specific level. A soft peg gives them a little wiggle room, while a hard peg means they're trying to keep it rock solid. And this right here, this lays out the fundamental trade-off. You can't have your cake and eat it too. With a floating rate, your central bank has total freedom to set interest rates and manage your domestic economy. But you have to live with a volatile currency. With a hard peg, you get that sweet, sweet stability in your exchange rate, but you pretty much give up control. Your central bank has one job and one job only: defend the peg, no matter what's happening at home.
All right, so after all of that, let's bring it all the way back home to where we started. We've looked at the winners and losers, what drives the price, and how governments try to get involved. So, what's the final verdict on our $6.6 trillion question? After peeling back all those complicated layers, the answer is actually, believe it or not, pretty simple.
It completely depends on where you're standing in the economy. There is no single one-size-fits-all answer.
If you're an American company importing electronics from Asia, or you're planning that bucket list trip to Italy, a strong dollar is awesome for you. But if you're an American farmer trying to sell your corn overseas, a strong dollar is a total nightmare. It's really that straightforward.
This final quote just brings our whole conversation full circle, doesn't it? The dollar's value isn't a report card on the nation's health. It's just a price. And a high price is only a good thing if you happen to be the one selling, not buying. So I'll leave you with this question to think about. Every country has to choose its poison, right? Do you want control over your economy, or do you want a stable currency? There's no perfect choice, just different sets of risks. So which risk is your country taking? And for whom does that choice really work out? Thanks for watching.